Welcome to the big game. Everyone tells you to save money and diversify your portfolio. But in 2026, the final nail has been driven into the coffin of the traditional 60-40 strategy. In this new world of persistent inflation and geopolitical risks, the middle ground is now a recipe for disaster. How is the top 0.1% of the world's wealthiest multiplying their fortunes while your bank accounts are eroding? They aren't just investing, they are performing financial engineering. Today, I will explain step by step 10 asymmetric strategies discussed behind closed doors by giants ranging from Nassim Taleb to Ray Dalio. By the end of these videos, your perspective on money will never be the same. If you're ready, let's begin.
Our first trick is the barbell strategy, popularized by Nassim Taleb, the father of the black swan theory. Most people invest in medium-risk funds, which Taleb calls the death zone, because those risks are often miscalculated. Example, think of it this way. You place 90% of your portfolio into ultra-safe havens, like short-term treasury bills or cash. This is your shield. The remaining 10% goes into highly speculative bets with massive explosive potential, such as cryptocurrencies, angel investments, or deep out-of-the-money options. The result, if that 10% fails, your loss is only 1/10 of your portfolio, which the safe side can likely amortize. But if even one of those bets explodes, like a startup going 100x, your wealth evolves overnight. You are now anti-fragile. You don't just survive chaos, you thrive on it.
Second trick, buy, borrow, die. Here is the biggest secret of billionaires. They never sell their assets. Why? Because if you sell, the government knocks on your door to take 20–40% of your profit in taxes. Instead, they use the buy, borrow, die cycle. How it works. You buy a valuable asset, like stocks or real estate. Buy. Its value increases, but you don't sell. Instead, you go to a bank and use that asset as collateral to take out a low-interest loan. Borrow. According to tax laws, borrowed money is not considered income. Thus, you have tax-free cash flow to live luxuriously or make new investments. The final act? Die. When you pass away, your assets transfer to heirs with a step-up in basis, meaning the cost basis is updated to the current market value, and decades of capital gains taxes simply vanish legally.
Third trick, Ray Dalio's all-weather portfolio.
Ray Dalio, founder of the world's largest hedge fund, views the economy not as a chaotic mess, but as a machine made of simple gears. His trick is the all-weather portfolio. Strategy? The economy is always in one of 4 seasons: high growth, low growth, high inflation, or low inflation. Most investors only prepare for sunny days, high growth. Dalio distributes money based on risk parity, allocating based on the risk of variable carries rather than its dollar amount. Example, when inflation spikes, gold and commodities protect you. When growth accelerates, stocks win. Remember Dalio's golden rule: pain plus reflection equals progress. Turn your mistakes into algorithms so the machine works for you.
Fourth trick, psychological arbitrage.
The hardest part of investing isn't the charts, it's the primal fear inside your brain. In 2026, the ultra-wealthy use psychological arbitrage to turn emotional swings into profit. 2 major traps. Herd mentality. If everyone is running toward a stock, it's likely about to bubble. Loss aversion. The human brain feels the pain of losing $100 much more intensely than the joy of gaining $100. This causes people to hold on to sinking ships for months instead of jumping off. The solution? Professionals surrender their emotions to checklists. They perform red team analyses, asking, why might I be wrong? When the market is terrified, you must be a cold-blooded hunter.
Fifth trick, RWA Tokenization. The great revolution of 2026 is democratization. Previously, you needed to be a billionaire to buy a skyscraper or own a piece of an NBA team. Now, there is RWA, Real World Assets Tokenization. Example, A massive office tower is divided into millions of digital shares, tokens, on the blockchain. You can own a room in that building with just $100 and receive your rent directly into your digital wallet every month. The ultra-wealthy keep more than 50% of their portfolios in these private markets because they aren't affected by stock market volatility. The closed doors are finally opening for everyone.
Sixth trick, agentic AI and no-code algorithms.
It's time to remove human emotion from trading. In 2026, you can create your own investment bots without knowing a single line of code. Scenario: Agentic AI systems can scan thousands of balance sheets, news feeds, and even alternative data, like satellite images of retail parking lots, on your behalf. Using natural language, you can command, if the S&P 500 drops below a certain level, move to gold. These systems ensure your strategy is executed with discipline while you sleep. The disproportionate power once held only by massive quant funds is now in your pocket.
Seventh trick, clean energy infrastructure. The world is hungry for energy, especially due to the massive power needs of AI data centers. The ultra-wealthy have recognized this and are providing subordinated debt to solar farms. The trick? You invest in a solar project and in return receive a fixed interest rate of 6 to 8% annually. These investments are often protected by 20 to 25-year power purchase agreements, PPAs. Even if the stock market crashes or a war breaks out, the sun rises every morning and you collect your money. It is a set-and-forget inflation-protected income stream. Eighth trick, athlete equity. This trick is wild, but it's one of the hottest trends of 2026, athlete equity. You can now invest in the future earnings of professional athletes like a stock. Example, you provide financial support to a promising young MLB or NBA prospect at the start of their career. In exchange, the athlete commits a percentage of their future massive million-dollar contracts to you. If that athlete becomes the next LeBron James, your $1 investment could return $100. This is a hybrid asset class with zero correlation to financial markets, based entirely on talent and potential.
Ninth trick, stop operational leaks.
Most investors focus on what they earn, but the wealthy focus on what they don't lose. Hidden costs in your portfolio are the termites of your wealth. Striking data. A management fee of just 1% per year can steal nearly 28% of your total savings over 35 years. High turnover, hidden commissions like 12B1 fees, and tax leaks significantly reduce your returns. Successful investors use passive index funds with expense ratios lower than 0.10% and utilize tax loss harvesting to increase their net returns. Financial success is measured by what you keep, not just what you make.
10th trick, global tax arbitrage.
Our final trick, where you live is more important than what you invest in.
In 2026, digital nomad visas and regional tax exemptions have turned into arbitrage opportunities. Strategy. Countries like the UAE, Costa Rica, or Barbados offer zero income tax or territorial taxation models that only tax income earned locally. Critical rule. Just showing an address on paper is no longer enough. According to substance rules, you must have a real economic tie to that country. With the right residency strategy, you can turn your gross earnings into 100% net profit.
As you can see, staying wealthy in 2026 is not a matter of luck, it's a matter of strategy. Each of these 10 methods acts as a fortress, protecting you against market shocks while providing massive upside opportunities. Remember, the greatest investment is always knowledge. Save this video, research these strategies, and build your own financial plan. Which trick surprised you the most? Let's discuss in the comments. We'll continue protecting your wealth in the next video. Stay invested.